which it ultimately did. Okay? And this is, I love it when the market breaks support and can't hold it. I love it. We'll look at that. It's called a crack and snap. And it's something I talked about in my other DVDs. How many have my DVD sets here? Okay, quite a few. Okay. I call this a crack. I think my first DVD was called a spring, but I love this. So here, market breaks support and can't hold it. Okay. What do we have here? That long upper shadow. Is that a shooting star? No, there's really no trend to reverse. Yeah. One of the things, one of the challenges we have is the market in an uptrend or downtrend. Something else to think, to define the candlestick signal. Something else that will help us, and we'll look at later, is seeing if the market is overbought or oversold. So obviously, even if you, for some reason, thought of this as a shooting star, which you shouldn't, we should say to ourselves, is the market overbought? And you don't need an oscillator to tell you no. So this shooting star becomes less important. And we'll look at that a little bit later. We're going to look at a lot of stuff later, huh? Okay. Here we have a dark cloud cover. Now with that dark cloud cover, is the market just visually, does that look overextended at the time the dark cloud cover emerged? Yeah, I would say so. It's overextended. It then becomes more likely when you have a bearish candlestick signal for it to be reversal. Again, in spite of that, I wouldn't short on the dark cloud cover unless we had it confirming something else. Yes?
Is resistance then the tallest wick there?
Yes, on the dark cloud cover, any of the candlestick signals, great question. The question is resistance at the upper wick or the upper shadow. Whenever you have a bearish engulfing pattern or dark cloud cover, the bearish engulfing pattern, the highest high, including the upper shadow, or the dark cloud cover is resistance, the bullish engulfing pattern, the piercing pattern, the lowest low, including the lower shadow, becomes your support level. Great question. The question is, can momentum be substituted for volume? We could use momentum. When we talk about oscillators, we'll look at momentum. The way most traders will use momentum is seeing if the momentum is confirming the move. So I guess in that sense, you could use it as a substitute for volume, because with non-Forex, if the market's moving higher, we want to see higher volume. In Forex, if the market's moving higher, we want to see the oscillator, whatever you're looking at, stochastics, RSI, also moving higher. But unfortunately, I don't think there's really any specific substitute for volume. But that could be viewed as something that can be used as a last case scenario. What's that? Oh, the oscillators? Yeah, oscillators are a lagging indicator. We'll have a section on oscillators, and I don't ever recommend trading solely on an oscillator. It's only if we get a candlestick signal confirming it. To me, the best indicators are the candlestick charts. It's pure price action. Everything else you're doing, you're getting away from the pure price action. The oscillators, the mathematically derived measurements, but there's nothing more important than the pure price action. Okay, here we have what I call a confluence of candles. The market's descending, but as it's moving lower, we have a couple of piercing patterns and then ultimately a bullish engulfing pattern. What's that? The first piercing pattern. Yeah, this would have been tricky, because he was saying you get excited when you see this, okay, because is it confirming support? Yeah. Now, let me ask you, is it a good risk reward? No, based on this. Remember, your target might be very different than mine, but based on the prior highs, those long upper shadow resistance area, that would not be a good risk reward. But you're right, I would think about scaling back on shorts if I was short. Get excited. The market closes under it. If you're long, you're wrong. Okay, get excited again. And this might be an okay risk reward. I have to take a look at my target would still be there. Okay, the low is the low of the piercing pattern. Is it still holding it? So it would still be long in the piercing pattern. It moved under the piercing pattern, but did it close under it? No. Okay, that's not quite a hammer, right? Because the lower shadow is not long enough. But nonetheless, that second piercing pattern is still holding. Okay. Now, this is a question. I don't know if it closed under the low of the piercing pattern, but to me, this would not be a decisive break. Now, for those of you who trade in black and white, say a close under the piercing pattern is a close, If I'm long, I'm out. I can't tell you, a right or wrong answer. But something like this, even if I don't think it closed under the low of the piercing pattern, but assuming it did, if it's a couple of pips, I would give it to the next day, at least the opening. But I'd still be a little nervous. So is the market making lower lows and lower closes? The piercing pattern is still holding, though. Okay. Still lower closes. Okay. Now, this is a very different scenario because we're going from lower lows to higher lows. We have a bullish engulfing pattern. What else besides this? What's with this bullish engulfing pattern? Look at the prior real bodies. Right, wrapped 2 or 3. It wrapped around. Right, it wrapped around 2 or 3 black real bodies. So now I would be very, very comfortable doing a trade here. Very comfortable. Risk reward is good. You have a whole bunch of signals here. Yes.
Would you also give weight to the fact that it closed above the previous candle's high?
The question is, would I also give weight to the fact it closed above the previous candle's high? Not too much. Not too much. To me, it's more important that it wrapped around a lot of real bodies. And you're going from lower lows to the same lows to higher lows. Okay. Mm-hmm. Support area. Okay, the question is, the first piercing pattern is confirming our support area, yes.
Then we have the second piercing pattern, but before the second piercing pattern, the black pattern is closing below your support area.
Okay, before, okay, here's the first piercing pattern. He's saying it's holding the support at the first piercing pattern. This is still holding support there. It didn't close under it. The next one, right, that's what we're talking about. That's, if you were long in the piercing pattern, you would have been out.
Would you consider doing short order?
Yes. Yeah. Yeah. Well, no, I don't. I shouldn't say yes, no. You don't know where the support is, so you don't know if it's a good risk reward. Okay. But based on this, it looks like a descending triangle. Remember, you could use Western technicals. Okay. A descending triangle means you have horizontal support and lower highs. And when the market breaks to the bottom of the descending triangle, you could take the height of the triangle and subtract it. Okay. So that's the way I would be playing it. So let's say we're short and we have a good risk reward. Let's say using the descending triangle as your target, and we're short now. The market broke the support level. In the real world, we're not going to say go from long to short. Okay, unless you have to have good psychology to be able to do that. I love the market. I hate the market. So the market does this, and then once it gets back up here, I would be out of short positions. The question is, would I get uncomfortable seeing this long upper shadow here? I might get a little uncomfortable because it looks like it's confirming. This to me is like a minor resistance area over here. I might get a little bit uncomfortable, maybe scale back a little bit, move up stops. But what I would probably do is look at an intraday chart to see if I saw any real bearish candlestick signals there. So the question is, would I get uncomfortable here and on this long upper shadow? And not too much, but if I saw, for example, a bearish engulfing pattern here on a 60-minute chart, I might get more uncomfortable. Okay, we'll move on to Harami. Okay, a Harami is a small, we're still looking at double candlestick lines. And we looked at spinning tops before, the small real bodies. Remember, spinning top and a small real body mean the same thing. The Harami is a little specific, more specific in its definition. What it means is that it's small real body within an unusually long real body. And the second real body could be black or white. This is a bearish Harami. The Japanese would say there's a change in the flow of the market. And a bullish Harami. The market's descending. By the way, these lines, these slash lines, to show us the market